Today we are looking at Adobe Inc. ticker symbol ADBE, and is this a buy in 2022? We're going to be talking about what Adobe is as a company, the products it has, and why it's been so successful over the last few years. Then we're going to be looking at the fundamentals of the stock, and then in the later part of the video, giving you my target of Adobe using discounted free cash flow and the Buffett Graham intrinsic value. But just before we get into that, let's have a look at what the price has been of Adobe this last year. You can see at the start of the year in 2021 it was around about $440 a share, hit its all-time high just about $700 a share, but has been on a pretty big downslope, down from 700 to 510. So is this a good opportunity to buy? That is the question I'm going to answer today. But first, can you give a like on the video? Helps me out with all the algorithm and all that YouTube fun stuff. But let's get straight into it. So what is Adobe? Well, Adobe is a multinational computer software company, and it is currently a SaaS business model. We're going to be talking about why that is really important for Adobe in a few minutes. But yeah, so Adobe has a wide range of content, including graphics, photography, illusion, video, media, multi-pictures, and print. And it has millions of users worldwide. Some of the flagship products that Adobe has is Adobe Photoshop, image editing software, which I'm sure everyone has definitely used. Adobe Illustrator, which is a vector-based illustration software. And finally, Adobe Reader, which is used for PDFs. And also, one thing I didn't know is Adobe actually came up with the PDF file themselves, the portable document format. So that kind of shows how big they are in the space. So why is Adobe such a powerhouse at the minute? Well, the thing is that Adobe are a SaaS company, which is a software as a service company, and this is the Adobe Creative Cloud, basically their entire product. So you used to be able to have single purchase items of Adobe. So you'd buy Photoshop for, I'll just say, $100 or £100, but now it is a monthly subscription service, which is very similar to Microsoft, which has had a massive share price upgrade since it switched the service. So you can see here, this is just on the individual. Photoshop is £10 a month every month to get everything, or to get the 20 plus Creative Cloud apps, including this all, £50 a month. That is a flat fee that they're getting every month from everyone who does this. And this is on the individuals. So you can see that £50 a month is pretty expensive, but a lot of people do deem this worth it because they use Photoshop and Illustrator constantly. And on the business side as well, for business users and companies that will be doing this, £60 a month, which would probably be about $100 a month. Then it's basically the Creative Cloud for Teams at a business level. So this is SaaS and why it's so successful. Right, let's just quickly get into the steps. So as I said before, Adobe has a share price of $510 a share, 52-week low of $420, and a high of just about its all-time high of $699, and it does not pay a dividend, but it does have a market cap of $242 billion. So is the PE ratio less than the market? No, Adobe has a very high PE ratio of 50.94, so that is obviously higher than the market at 28.5. The market average at 28.5. Next, is the revenue increasing? Yes, it is. 9 billion to just shy of 16 billion, so that is a pass. Next, is the profit increasing? Yes, it has, almost doubled, 2.6 billion to 4.8. Now, one thing I just want to draw attention to this on this profit, you can see this is the revenue increasing. These are the earnings or the profit. It is down from 2020, where it was over 5 billion, but it is still higher, considerably higher than it was. Revenue has been steady. Profit has gone up quite a bit there, but they've still managed to increase their profit quite a bit. And obviously, revenue has not doubled in that time, almost doubled, and profit has gone up, well, almost 3 times. So that is very good to see. Next is the shares outstanding decreasing. Yes, Adobe are rewarding shareholders by buying back their shares. It's gone from 490 million to 481 million. So that is a pass. And finally, is the free cash flow increasing? Yes, it is, 3.7 billion to 6.8. So that is another pass. So what does that give us in total? Obviously, 4 passes and 1 failure. The failure being that the PE ratio is very, very high. If we look at the free cash flow ratio, 242 billion divided by 6.8 is about 35, which is lower than the PE ratio. But yes, that is a bit of a worry. I think this will probably mean the valuations are a little bit high on discounted free cash flow, but let's have a look. You can see here we've got discounted free cash flow, and this is calculating the future free cash flows for Adobe, and what we're going to do is calculate the future values of this free cash flow and discount it to today. So what does this discounted free cash flow say on the model? Well, actually, very interesting there. It says Adobe is about fairly valued with a calculated stock price of $506.72, so a slight discount there. Now we want to look at Buffett Graham intrinsic value, which takes the share price with earnings per share, the expected growth, and this surprisingly says the stock is overvalued at around about $385 a share, and then a Graham price, which is a buy and hold at $290. So discounted free cash flow says the stock is about fairly valued, and the Buffett Graham intrinsic value says it is overvalued. Now, one thing I want to do is just quickly add in some other analyst estimates on the revenue. So you can see here, these are the average analyst estimates of 17.95 billion and 20.6. On the high side, analysts are thinking it could be up to 18.3 and 21.54. And actually this would then increase it, and it would say that it does have a potential value of $535.65. So that is a little bit more on the positive side, but still discounted free cash flow, and Buffett Graham is saying that it is about fairly valued, and Buffett Graham intrinsic value does not like the stock. So that is quite surprising. Even with that high P ratio, discounted free cash flow still likes the stock. Also as well, just to sort of give more of a bullish case on this as well. If we were to look here, and over the past 5 years, it grew at about a 45% rate. Obviously, I don't think it would grow at that much again, but then it would be almost double the stock price. In the next year, it is meant to grow at about 18%. So that would give it a fair value of 445, once again overvalued. So if it was able to grow at around about 25% over the next 5 years, then it would be a buy. Analysts are currently thinking it's around about 15%. But so 25 would be the bullish case. Even then, if we look at these numbers here, which was the revenue growth rates, that would be about 15%. And if it was to put that in again, that is what the analysts were saying. Sorry, that is not earnings per share. I want to change earnings per share to 15. 15, once again, about $100 overvalued at the minute. One last thing I want to just look at is the analysts, and they are actually saying it's disagreeing with me. Basically, a moderate buy, 16 buying, 6 holding, have a calculated stock price of this time next year at around about $670.95, which is a 31% upside. On the high side, they're saying it could be going as high as $765, which is interestingly enough, because if we were to quickly compare this and change this growth rate to about 45%, actually that would be around about, what, 35% growth over the next 5 years to get that number. So that is a bit on the high side, but average 670, and even on the low side is $611. So analysts are pretty bullish on the stock. I like the stock. I like the fact it's a SaaS model, but I'm just a bit surprised that the models are saying it is a bit overvalued at the minute. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it, and I'll catch you guys next time.